Just a few months ago, I posted a video warning investors in ARK and prospective investors in ARK to watch out. This was on February 7th. Since then, the ARK funds are down something like 35, maybe even 40% since that peak. You can go to the video, I'll leave a link to it below, calling out why it could potentially face a dramatic decline in the near future. So I think that was well timed, and it subsequently sort of has played out, unfortunately. So since then, last Friday, just a few days ago, in early May, Cathie Wood was talking about how she loves this setup. Despite being down, 35%, she loves this setup, as she's saying the rotation is good news. Down today, another 5% drop today. And so folks are wondering, like, well, wait a second, what's actually going on? And do I have any more sort of calls on this setup? So is now the time to buy, given that you've seen her fund get crushed? How about some of the particular holdings, like we'll talk about Teladoc in a second? And let's do some additional thoughts on Cathie Wood's comments. So let me bring it to me real quick. So my name is Daniel. You're watching Unrivaled Investing. I have a background working on Wall Street, investment banking, multi-billion-dollar hedge fund, that sort of stuff. So if you're interested in following, my channel and where I call out potential multi-baggers, that's the goal of this channel, by the way, is looking for the types of companies that I think can go up hundreds or thousands of percent over time. So I definitely am interested in what Cathie Wood does have to say, because she does have a track record of finding these things. I don't always agree with her, and I definitely think there are sometimes risks that she calls out that that she doesn't call out that I think are sort of big red flags. But you know what? She has identified enough of them that it is interesting to me to see what she's buying. And sometimes there's overlap with the holdings. Like today, we're going to talk about Teladoc, which is one of her top holdings. So what is this loving, where she's at, in terms of this drop, this significant, rotation, and saying that she loves the setup. And so why could you love the setup where it's down, where her funds are down significantly, her investments are down significantly? And that's because, in her opinion, the only thing that's changed is price. It's not the fundamentals of the business. It's not the, it's not the long-term valuation perspectives. It's just price. It's the short-term valuations are coming in. And so now, instead of getting, let's say, 15 to 20% annualized returns, and that's what she was previously penciling out. Now she's like, hey, I might be getting 25 to 30% in the ensuing 5 years. And that's sort of what she thinks this drop in valuations might result in. And she likes the fact that the market is broadening out, sort of getting more exposure to other assets other than the innovation companies or the high growth companies that she owns, like, let's say, financials and energy stocks, which have ripped higher. I've called out in several other videos why I think they're ripping higher, as I think it's really due to more of a macro concerns about higher interest rates and inflation. And conversely, that's also why these growth stocks have gotten hammered. So that's sort of a separate point. But what do I think? Do I think that she's actually right to say, hey, you know what, this is great, now that this is bargain hunting, price is down, nothing has changed but the price, hence this is a bargain? What do I think about that? I actually think she's wrong, and it's for a different reason. And I think it really comes down to that the price isn't the only thing that's changed. I think what's changed is that the valuations are fundamentally different now, partly because of that inflation aspect, where people are saying, wait a second, long-term rates might be going up, in which case how you value assets 5 years from now might be quite different. Because if there's a true opportunity cost with your cash holdings, you might say, well, wait a second, you know what? I'd be more willing to own, let's say, a 3, 4, 5% bond that's low, low duration, low risk, versus some of these higher growth plays where the business model may not have proven itself out yet. You might want a lower valuation if you're not getting cash in that given year, just purely from an opportunity cost perspective. If a company doesn't have some sort of cash to the shareholders, whether or not it's buybacks or dividends, they might say, you know what, I want to get a better discount on those stocks. And I think that is a fundamental change with how these businesses are valued right now, because the threat of inflation is definitely higher, in my opinion, and the threat of higher rates. And that's what we're starting to see. And there's also, I would argue, a second core threat that has changed, which is that the odds of Federal Reserve, let's say, increasing support for the market, that Fed put, I think that the odds of that has actually gone down with the risks of higher interest rates. And effectively, the Federal Reserve has said, look, yeah, the interest rates or inflation's going to go higher than we expect for a little, or higher than we'd like for a little while, but hopefully it's transitory. If it's not, then you could say kaput to the Fed put. Like, it's not going to happen. They're not going to be in a position to keep buying treasury bonds and creating hundreds of billions of dollars of new money each month if inflation starts running hot. And you're certainly seeing it across many different asset classes. So I think you're now seeing a big shift in investor sentiment where people are like, wait a second, you need to show me the money. You need to show me the business model and prove to me that there is real profits here, that there can be real cash flows that I can get as a shareholder. Otherwise, there's a real possibility that I'm going to have cash interest in short time with potentially higher rates in the future. So I think investor sentiment is changing. This isn't just a price. This isn't just like, hey, bargain bin shopping. Hey, get Cathie Wood her investments at a 30% discount. I think there's a legitimate change to how investors are perceiving things 5 years out from now. And one might argue the real odd anomaly was really this past year in terms of how parabolic things actually went. So that's something to think about. Let me give you an example of a particular stock. I mentioned Teladoc a couple of times. So Teladoc stock is down about 50% in just a few months. For a bit of background, I actually bought Livongo stock, which Teladoc later acquired. So TDOC, I own a little bit. It's a teaser position, but I owned a much bigger position in Livongo that I bought. I bought Livongo in the 20s, and you effectively got this nice merger with Teladoc. And so recently at Teladoc's peak, which is one of ARK's top holdings, I was up nearly 8x on Livongo. So that was a very satisfactory return in short order. And now it's in Teladoc stock. So my cost base in Teladoc effectively was very low. Now, I had locked in most of my gains by the recent high, in February, because I thought the valuation was very, very full and they needed to prove out their margins. They needed to prove out their business model. Like, look, making multi-billion-dollar acquisitions, you need to prove yourself with the execution. These are not easy, acquisitions to sort of process, and a whole business model based on, hey, let's just keep gobbling up pieces. That is a much tougher business model to execute on. And so I had some concerns about that. I had some concerns about the valuation, and that's the reason why I locked in these multi-bagger types of return for, my Livongo, then Teladoc holding. And so the subsequent decline, this 50% drop, it really hasn't bothered me that much, just because the position I'm holding, it's really small relative to what it was. And it's only a tracker position at this point. So 50% drop. Now it's more like, let me track this and see if now is the time to buy. And that's part of the reason why I want to make this video, because I think a lot of folks are asking themselves, I know I've been getting a lot of questions from Unrivaled Investing Journey subscribers saying, hey, Daniel, is now the time to buy Teladoc? I see that you own it in your own personal portfolio. I see that Cathie Wood, she's been a big, bull on it for a while. Is now the time to buy? And I wanted to call out that I'm not buying it yet. And so, now keep in mind, it is oversold. So when you see something drop 50% in a month or two, of course you could have a nice bear trap or bull trap, where it rips higher and bulls get excited and then just breaks lower. So you could definitely get that aspect to it. But so because it's so oversold, you can get that sort of bounce. But it's not, even at around $140 a share right now, I'm not really pulling the trigger personally to say, hey, let's back up the truck, on making this a much bigger position. And let me discuss why, and let me make my screen, embed my screen. And so here it is. Here's their first quarter 2021 results, where they're saying, look, we posted incredible revenue growth, like 150% plus growth, total visits increasing 56%. They're talking about the number of consumers enrolled in their chronic care program tripling year over year as they're focused on a whole person care, which is great. It's going beyond of just like, hey, let's just tackle a given problem, which is you need to consider the whole person health. And when you consider that, you can have much better outcomes, much better policies, much better practice. And so that's what Teladoc is doing. That's something that Livongo had talked about before. And so they're putting up great growth numbers, at least in the first quarter. But then you need to understand, so even though they're effectively penciling out like 80-90% revenue growth, they're still expecting to be pretty unprofitable this next year, with negative EBITDA of 120 to negative 100 million. So negative 100 to negative 120. Now, a lot of that, they're going to say the adjusted is going to be positive because you have to factor in integration expenses or one-time expenses or a lot of stock-based comp. And so my view is those are real expenses, albeit the integration expenses are more one-off, But, stock-based comp is a real cost, and so I prefer to look at EBITDA versus adjusted EBITDA, and this is effectively a cash burn business or break even at best with negative 100 million EBITDA. So that this is a business model where people are saying, well, wait a second, in this environment, people need to see the profits. That's what people are starting to say. Hey, I want to see the margins. And that's what gets to this valuation. So here's a valuation template, in terms of thinking about Teladoc. And of course, this is a framework. Could the stock price go way higher, way lower? Of course. But I like to work from a logical framework. Where I look at this and I'm saying, okay, it's a 20 billion plus company. They're effectively guiding to, let's say, 80 to 90% growth this next year. What are their margins long term? And this is a key component. Is their gross margins are, let's say, 70%, a little under 70% now. Maybe their optimized operating profit could be 20 to 30%. They're unprofitable now, but maybe they could be at 20 to 30% in the next few years. Maybe. And so that's how people think about valuing them. And that's part of the reason why it's been such a wild ride, which is that when you have a business model where it's like, well, wait a second, you need to prove your margins. And people are like, I might want some cash in between now and then, or I want to have it own a security that's paying me. Then people might change how comfortable they are holding it. And so you get this different dynamic with the holders where it turns into a show me the money type of story of, what are your actual margins? Can you actually prove your profitability? And so that does, create enhanced volatility with the stock, because then it's like, well, okay, what's the actual value here? People get a little more nervous when you don't see the margins right now. When you have a company that's already profitable and they're like, yeah, this is our peak margins and this is what we look like, that's a solid story. But when you have to bank on a company saying, oh yeah, we're hoping to get there in a few years from now, investors might get a little nervous, especially when they start considering other alternatives, especially as rates start to rise. And I think that's the crux of where I disagree with Cathie Wood, saying, look, higher potential interest rates is a fundamental disagreement with where the market's at today versus where it was a few months ago, where people are starting to reassess what's the risk of higher rates in the future. So that, that's part of the reason why, as I look at this valuation framework where I'm saying 80 to 90% growth this year, 20 to 30% profit margins, 25 to 45% annualized growth in the ensuing 4 years, and 15 to 25 times N multiple for 5 years from now. And I'm looking at 140% upside and downside in nearly 50%, which honestly isn't that compelling, isn't crazy like, yes, I must own this. And that's the reason why I haven't bought, I haven't made it a big position. So for the investors out there, I say buckle up, baby. Like, you can be in for a wild ride with this. Now, maybe they do some great, acquisition that enhances their growth from here. But, there's a good chance that in the next 5 years, the stock doesn't really go that, doesn't really go, might not go anywhere, but it might do it in an interesting way. And so I'm not super compelled by the current valuation. That said, I am finding some things that I do find a lot better risk reward. For example, I think a few days ago, I called out Alibaba stock, so you can check out that video. And I'm currently looking at a potential liquidation play. So a stock that trades below liquidation value that I think has at least 3x upside. So and that's the type of situation I'd want to own in this market, where people are increasingly concerned about growth prospects. People are increasingly concerned about, higher rates and potential, hey, what's the higher opportunity cost? And so finding a potential liquidation play where it's trading below liquidation value, that gives me the peace of mind that I'd want while still having that multi-bagger potential. That's the type of company that I'm interested in. And I think that might just be, I'm still doing the research, but I think that might be the multi-bagger that I call out for Unrivaled Investing Journey subscribers later this month. It should be later this week if all the boxes check off as I'm still doing the work. But that's part of my value proposition for Unrivaled Investing Journey subscribers, where this is for the folks that are looking for a journey, looking to build out their portfolio over time, is that each month I call out one new potential multi-bagger type of company that I think has, asymmetric risk reward. And I like, the prospects of, let's say, 200, 300, 500% upside over time. And then for those folks that are interested in following my personal journey to see what am I doing, in my own investment portfolio, the first week of each month, I call out my full holdings, and you can download that and you can see everything I own. And if there's any material changes in the portfolio, I also do call that out, throughout the month as well. So, if this video, looking at Teladoc, thinking about Cathie Wood and her positioning, saying, hey, I love it, and I just don't love it. If this has been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.